Hello everybody, this is Craig Marr, and today I'm going to be talking about money, and I'm going to be talking specifically about the stock market today. And this is, about the stock market, for my beginning investors, my beginning people that have very little experience or no experience with the stock market. Now it's normal for you to be afraid of something that you don't understand. And I was afraid of dogs as a kid. I was scared of driving a car, going out on my first date. First time, I went to school. First time I went to college, I was afraid to own my first piece of real estate. But how do you overcome that fear, Sometimes in life you have to grab it by the horns and dive into the water. But I don't want you to dive like a full dive. Just get your tippy toes into the water. That's how you get started with the stock market, okay? Now, can't I lose all my money in the stock market? You could. I have a friend that did lose, about all of his money in the stock market, and he had, about, $250,000 in the stock market. So that's not, the stock market is not something you play with. It's serious, Oh, what about 1929, that great crash? Well, that was a crash where people lost 90% of their money that they had in the stock market. Hey, that's really serious. Okay. But if you really want to make money in the stock market and be safe, and safety is a very important consideration when you're dealing with the stock market, never trade more than 10% of your net worth. My friend lost all that money in the stock market because he was probably trading his life savings. And that's just very, very dangerous, Okay, but with all this risk, why would I even recommend the stock market to you guys? Okay, now if you have, anywhere from $500 to $1,000, I want you to open up an account with a large brokerage firm. You could go in there with Robinhood, but why not go in there with those companies that have been around for decades and decades, like Charles Schwab, Merrill Lynch, E-Trade or Ameritrade, TD Ameritrade. Those big stock brokerage firms have been around even before I was born. So those are the ones I really recommend to you guys. You got to get your feet wet and overcome the fear. That's what's holding you back. Now, I know that some of you got jobs, some of you got careers, and you get some leftover money. And leftover money is a good thing to do, but you got to realize that money, it goes down. It's always going down. It's always depreciating. So, if you stick it in the bank or stick it under your mattress, it's going down all the time. 10% nowadays is the inflation rate. Every time you go to the gas station, you'll see what I mean. Every time you try to pump gas nowadays, it's, around here it's like $5 a gallon. It's just highway robbery. But, the next time, you get an extra $500 or an extra $1,000, I don't want you to just automatically just stick it in the bank, go to a CD, and making 1%, 2%. I really want you to think about putting that $1,000 into the stock market. Now, if you're going to be a trader, and about half of you will become traders, the other half will just become buy and holders. And there's no right or wrong here, but do realize that when you become a trader, most traders, they lose money, especially beginners. But the advanced traders, the ones that have been doing it for years and years, they usually make money. But it's like any other activity, any other game. You've got to know what you're doing. You've got to get experience if you're going to become good at something. I believe money can be made as a trader, but because trading is a little bit risky, it's like gambling. I'm only going to put up maybe 10% of my money into trading. The other 90%, you want to put it into stocks or mutual funds or ETFs. If you're going to become a trader, your number one goal when you're starting out, your first month of trading is don't blow up the account. I know that a lot of you, your first month or first year of trading, are going to do just that. But that's why you always trade when you're starting out with a very small account. Don't try to, a beginner should never take, their yearly salary and just start trading wildly and losing money, and pretty soon there goes your savings. I don't want you to do that. So, okay, if you blow up the account, you've only lost like $1,000. Big deal, you can probably get that money back. And the first thing is that, your first month, your first 6 months, your first year of trading, experiment. That's the time to experiment when you have very little to lose. I don't want you to be experimenting when you have a six-figure account. You don't want to be trading and experimenting when you have that kind of money. Now, instead, the first thing you want to do is get up on the trading platform. Now, whether you're doing E-Trade, you're doing Merrill Lynch, you're doing Charles Schwab, they each have a slightly different platform, trading platform. But whichever of those brokers you select, just learn their particular platform. There's going to be a part where you're trading, there's a part where you're buying, there's a button where you're selling. And you want to learn which are the correct buttons to push when you're making a trade. Now, you could go out and buy stock. It might cost you $100. You buy one share of Apple, probably be $120. Let's say you wanted to diversify your portfolio. Okay, go out and buy one share of Coca-Cola, $50, $60. Okay, wow. You gotten started already, because stock pays dividends. Stocks pay dividends, so you're making money as if you're buying a rental property. You buy a rental property, it's going to spin off income. And you buy one of these blue chip stocks, it's going to spin off 2%, 3%. Okay, big deal, what's that, $2 or $3? It's a start, and you got to get started somewhere. Why not learn the basics? Check the Dow. What is the Dow? Okay, they're always talking about the Dow. Dow Jones Industrial Average is your measure of the pulse of the stock market. Right now, I think the Dow is at about 33,000, give or take a few hundred. When the Dow rises, usually your stock rises. This is not always the case. I see stocks like Walmart and Netflix actually going up, even though the stock market in general is kind of in a bear market. But if you track, stuff like SPY, or the QQQ, These are ETFs that we often buy. They will generally go whichever way the Dow is going. Dow's going up, those are going to go up. Dow's going down, those will go down with it. But sometimes when you have stocks, they don't necessarily always follow the Dow, but they generally do. And then you don't want to panic if you see the Dow falling 200 points in one day. That's just normal market volatility. What should I do now that I've bought some Apple and some Coca-Cola or IBM or one of these really solid stocks that's been around for ages? Just wait. It's a long-term stock market. It's a long-term investment. I can never predict from day to day or hour to hour or even month to month what a stock is going to do. No one can predict that reliably. If you could, he'd be a millionaire, I guarantee you. Now, the first thing you got to think about is, what stocks should I buy? Now, I like the blue chip stocks. I like Apple. I like Microsoft. I like Amazon. Just pick. If you haven't heard of that stock, don't buy it, because you don't know whether it's going to be another Enron. It's headed toward zero. Stocks will occasionally do that. So you got to be fairly careful about your stock selection. Now, I know that if I buy, a steady, stable stock, then it's going to, eventually go up on me. But if I kind of mess around with stocks like, Netflix and Tesla, you don't know what it's going to do from month to month. It could go up 100 points, go down 100 points. I, prefer to stay away from these yo-yo stocks that are constantly going up and down, and I don't know where the hell it's going, to tell you the truth, Now, mutual funds and ETFs, these are exchange-traded funds. These are good if you want stability. SPY, QQQ, these are solid, stable stocks. They're not just one stock. They're composed of a bunch of stocks. So, when you've got, 10 different stocks in your ETF, there's some stability there, Because what you really want from the stock market in the long term, over, let's say, a 5 or 10 year period, is steady, stable growth. That's what you want. Now, you can own stocks or mutual funds or ETFs. My rule for stocks is, if I've never heard of it, then I don't invest in it. I want that company that's going to be around 10 years from now, 20 years from now. Find out what the top 30 stocks in the country are and buy these. Generally speaking, buy low, sell high. Okay? Always try to enter a stock. If you're going to buy a stock for the first time, always try to enter at a low point. Don't try to buy the stock at its high point. You're just going to lose money. Now, when the Dow goes low, when the Dow's goes under 30,000 or under 25,000 or lower, think about buying into the stock market. Bigger. Go bigger. Now, I know you like to put your money in a bank, but is it safe there? It's probably not as safe as you think that it is. But if you put your money in the stock market, I think you'll make on average about 10% interest in the stock market over time, compared to maybe 1 or 2% at a bank. Don't forget that historically the inflation rate's been at 3%, and so at 1 and 2% rates, you're simply losing money every single year from inflation. Now, do rich people put their money in a bank? I think one way for you to become wealthy is to imitate wealthy people. You want to imitate Warren Buffett. You want to imitate a Charlie Munger. You want to imitate, a Donald Trump or a Robert Kiyosaki. These are the guys that have really made it in the financial world, and you want to copy them to some extent. What stocks does Warren Buffett like to buy? What stocks is Warren Buffett selling? That means when he sells off, that means he didn't like that particular stock, you know. Now, this is kind of why I like the stock market, is because over the last 50 years, most of the 10-year periods have shown growth 8 out of 10 times. Now, there's always going to be 2 times in a 10-year period when there's a loss. But I would say that's 4 to 1 odds. Those are still pretty good odds, you know. Now, during any random 20-year period, I'm talking about from 1950 to 1970, 2000, 2020, over any random 20-year period, this is over the last 50, 60 years, you always come out ahead in the stock market. In other words, whatever money you had like 20 years ago will be more than what you had. Now, there have been many stock market crashes, but the market has always corrected and come back every single time. Uh-oh. Well, that's all for today, folks. Thanks for watching.